Hey, I'm Emma, with Wealth Builder. Alright, let's dive into a lecture on money today. We're tackling the exit strategy for index funds. Specifically, how do you draw down a portfolio of cash and stocks? Let's get into it. In today's lecture, we'll be answering questions like these. How should I withdraw from a portfolio consisting of cash and stock index funds? I currently have a 50-50 split between stocks and cash. Can I apply the 4% rule? What do you think? I bet there are quite a few people out there wrestling with similar concerns, right? Well, stick around and learn some hints to resolve those worries in today's lecture. So, that brings us to the topic of how to draw down from index funds. Sophisticated index investors will all tell you the same thing. How do you draw down from index funds? Just withdraw the amount you need when you need it. That's their answer. For example, let's say you retire at 65 and start living on your pension. You receive a pension of $1,000 per month. But this month, you want to spend $1,500. So, you're short $500. Then the idea is, okay, I'm short $500, so should I sell $500 worth of my index funds? That's the basic idea. At its core, that's all there is to it. However, I think quite a few people find this answer unsatisfying. Because even if you say just withdraw the amount you need, people worry, what if I run out of money while I'm still alive if I keep withdrawing like that? That's a valid concern, right? Plus, humans are creatures that feel stressed by having to think and decide each time. It's like, we want a way of thinking that allows us to deal with it more mechanically, you know? And that's where the 4% rule comes into play. The 4% rule basically says, you can withdraw 4.0% of your assets each year. Don't worry, in most cases, your money won't run out. That's the gist of it. Now, let's delve into it a bit more. Alright, I'm going to introduce you to two versions of the 4% rule. First up, the first version. The first 4% rule is to keep withdrawing a fixed amount, which is 4% of your asset balance at the time of retirement. For example, let's say you retire at age 65 and have $500,000. Then, you take a fixed 4% of your assets at retirement. So, 4% of $500,000 is $20,000. You keep withdrawing this fixed amount of $20,000 every year. That's the first, fixed amount version of the 4% rule. And the second version is to keep withdrawing a fixed rate of 4% of your asset balance each year. So, in the first year, it might have been 4% of $500,000, but in the following year, it will change depending on the stock prices, and so on. You keep withdrawing at a fixed rate. So, there are these two versions of the 4% rule. Okay, so you've got that so far. Now, considering the simple portfolio of just stocks and cash that I recommend, the question is, which of these two methods should you go with? My conclusion is that it's better to adopt the fixed rate withdrawal approach. That's the second one, basically. The 4% rule from the Trinity study is based on US Treasury bonds and US stocks. Okay, you get that. But then the question becomes, should I withdraw from cash first? Or from stocks? What should I do? That's what people wonder, right? Don't mix up your cash. So, with the premise that we're adopting the 4% fixed rate withdrawal method, let's get to the main point. But before that, let's confirm one more important thing. Even though it's all called cash, the cash in your emergency fund and the cash you have for investment are completely different things. Your emergency fund is money for your living expenses. That includes money you keep in your bank account for credit card withdrawals, or money to maintain your living if your income decreases due to injury, illness, or job loss. It's money for those kinds of purposes. On the other hand, investment funds, this refers to your savings. It's money you don't plan to use for living expenses for a while, at least not for the long term, like 10 or 15 years. Or, it could be money you want to hold as cash now to lower investment risk. For example, cash is ultra-low risk because its price doesn't drop even if the stock market crashes. It's convenient for buying a lot of stocks cheaply. In other words, it's like standby funds for investing. That's the idea. So, the first thing is to make sure you don't mix these two up. And with that in mind, here's how we can think about the 4% withdrawal strategy. Please take a look at the next graphic. Here it is. This illustrates a situation where someone has a solid emergency fund secured and an investment portfolio of 70% stocks and 30% cash. For this person, it's okay to withdraw 4.0% annually from the investment portfolio. While the fundamental withdrawal strategy for index funds is to withdraw only the necessary amount when needed, we're deliberately ignoring that for now. You're okay to mechanically withdraw 4.0%, even if it's not the exact moment you need it or if it exceeds the necessary amount. The reason for this is that the expected return of this portfolio exceeds 4.0%. Next, please take a look at this table. Here it is. If we assume the expected annual return for stocks is 6.0% and the expected return for cash is 0, because cash doesn't generate income. If you keep $10,000 in cash, it won't increase, right? Then, the expected return for this portfolio, using a weighted average, becomes 4.2%. So, looking at this portfolio long-term, since it's expected to grow at an annual rate of 4.2%, it's reasonable to withdraw 4.0% annually over the long term. That's the logic. This withdrawal method, viewed long-term, means your money isn't likely to suddenly disappear, it has the potential to grow, and considering you don't know when you'll pass away, it allows you to use a reasonable amount of money. So, it's probably fair to say it's a safe approach. So, I've created a quick reference table for you. The bottom line is this. If your portfolio's expected return is 4.0% or higher, then it's generally okay to withdraw a fixed rate of 4.0% annually. Over the long term, your money shouldn't decrease. That's the idea. And with that, here's the quick reference table I made to help you check if your portfolio's expected return is 4.0% or higher. The vertical axis shows the expected return of your stock index funds. Now, you might be wondering, what percentage should I use for the expected return? Can I just decide that myself? Well, it's up to you. But generally speaking, optimists might look at 8% to 10%, typical investors maybe 5% to 7%, and conservatives around 3% to 4%. It's up to each individual what they project. There's no single answer. Because we can't know the future. So, what do? I personally assume an expected return of 5% to 7%. On the other hand, the horizontal axis shows the percentage of your portfolio invested in stocks. And the areas highlighted in yellow are the portfolios where the expected return is 4% or higher. In other words, this is the area where it's probably okay to withdraw a fixed rate of 4.0% annually. Looking at this, I hope you can consider your own outlook and see how your portfolio aligns. Okay, let's wrap things up. Finally, let me reiterate the key takeaways from today's lecture. The fundamental approach to withdrawing from index funds is to do so only when you need the money and in the amount you need. However, for those who prefer a more planned and systematic approach, the concept of a 4% fixed rate withdrawal can be effective. By considering the percentage of stocks in your portfolio and your own expected return for stocks, you can get a sense of whether a 4% annual withdrawal is sustainable in the long run. It serves as one piece of information for your decision-making. It's crucial to clearly distinguish between your emergency fund and your investment funds. And when making withdrawals, be mindful not to significantly deviate from your ideal stock-to-cash ratio. Whether you withdraw solely from stocks, solely from cash, or a combination of both, the choice is yours. Having said that, I know some of you are probably thinking, just give me a rough guide. So, as a general rule of thumb, if your allocation to stocks is 60% or higher, then I think it's likely okay to withdraw at a fixed rate of 4.0%. It would be my sincere hope that today's lecture serves as a helpful guide for your wealth building and future financial planning. If you found any part of today's discussion insightful, please do consider subscribing to the channel and giving it a thumbs up. We'll continue to share financial information that will be beneficial for you in the future, so please stay tuned. That concludes today's lecture. Thank you very much for watching until the end.